Welcome back to Calvin Mateo, the channel where we tear down the hype and hand you the raw data. Today we are cracking open one of the most controversial stocks on the market. Palantir is trading like it is priced for absolute perfection, and the huge question hanging over every single share is simple. What actually happens next? We are going to walk through a viral sales machine, a jaw-dropping insider sale, a famous investor betting on collapse, and the exact price levels that will decide this stock's fate in the coming weeks. If you find this breakdown valuable, do me one quick favor and smash that like button and subscribe, because we drop deep dive stock teardowns just like this one every single week. Now here is the truth. The real story of Palantir is a profound structural tension between bulletproof software execution and eye-watering valuation multiples. While the company's second quarter numbers look absolutely otherworldly, there is a hidden geographic bottleneck that the bulls are completely ignoring, and we are going to uncover exactly what it is in just a few minutes. To understand how this tension is setting up a high-stakes collision, we first need to examine the immediate pressure points building in the market. Right now, Palantir is on a massive collision course. On one side of the equation, we have a fundamental engine that is executing flawlessly, driven by a viral corporate sales cycle. On the other side, we have an overbought technical setup colliding with critical resistance levels, while insiders are quietly liquidating millions of dollars of stock. This creates what I call a critical pressure matrix. This is not just about whether the company is good or bad, it is about how much perfection is already baked into the shares. At first glance, the momentum seems unstoppable. But before you get too bullish, we have to look at what has been printing on the tape over the last few days. And that tape has been incredibly busy, revealing three major developments that shook this stock this week. If we look at the last 96 hours of market activity, we can see this structural tension playing out in real time. On August 19th, Palantir hosted a massive bootcamp event that attracted a flood of corporate interest. The very next day, regulatory filings dropped, showing a massive insider stock sale by the CEO himself. And then on August 21st, a defensive merger was announced in Europe, explicitly designed to block Palantir's expansion, just as macro traders began bracing for the Federal Reserve's Jackson Hole Symposium. This is an incredibly fast-moving tape. It shows that while the company is executing beautifully, the competitive and regulatory landscape is shifting rapidly right underneath its feet. Let's start with that first event on the timeline, because it represents the core engine of Palantir's entire growth story. That event was the second AI Sovereignty Bootcamp, and honestly, the numbers are hard to believe. In a single day, Palantir drew in nearly 100 unique organizations. This brings their total bootcamp outreach to nearly 200 organizations in less than 30 days, including massive players like Dell, HCA Healthcare, Shark Ninja, and even NATO. Think about how insane that is for a moment. Instead of spending months trying to convince executives in boring, drawn-out pitch meetings, Palantir gets them all in a room and helps them build production-ready AI applications in a matter of days. This is a brilliant viral sales strategy that bypasses the traditional corporate sales cycle completely. But it raises a massive unanswered question. How many of these organizations are actually going to convert from curious looky-loos into real paying customers? Well, we can actually begin to answer that by looking at how their current customer base is already behaving. If we look at the hard financial foundation, we see an outstanding 157% net dollar retention rate. Let me explain why that number is so powerful. It means that Palantir's existing customers are not just staying loyal, they are aggressively expanding their usage, spending far more this year than they did last year. This elite internal growth is exactly what allowed management to raise their 2026 revenue guidance midpoint all the way up to $8,154 million. Now here is where the math gets really interesting. If even 25% of those 200 bootcamp organizations convert into paid contracts, this massive guidance figure suddenly becomes a highly conservative baseline. The operational momentum here is overwhelmingly, undeniably real. But before you run out and buy shares based on that beautiful math, we have to address a glaring vulnerability hiding in their revenue mix. Here is where the story starts to get far more complicated. While the global AI narrative sounds incredible, the reality is that Palantir is heavily dependent on a single market. United States revenue now accounts for 81% of their total sales. That means this is a highly concentrated US AI-centric business that is trading at a premium price which assumes total global dominance. And international expansion is now facing severe friction. Just yesterday, Arcturus Data and Acrivia Health announced a £140 million defensive merger over in Europe. This merger is explicitly aimed at blocking Palantir from securing the lucrative United Kingdom NHS patient data market. So ask yourself this: if geopolitical pushback over data privacy intensifies across Europe, are Palantir's international growth projections effectively dead on arrival before they even begin? And that geographical bottleneck brings us face to face with the ultimate debate, the one that keeps every analyst up at night: the valuation multiples. When you weigh these bulletproof operational metrics against the market's actual pricing, the disconnect is genuinely staggering. On the left side of the scale, you have a flawless land and expand bootcamp strategy and freshly raised guidance. But on the right side, the stock is trading at a price to sales ratio of 67 times. It is carrying a trailing price to earnings multiple of 147 times and a forward price to earnings of 108 times. These are price for perfection multiples in every sense of the phrase. Here is the part that should stop you cold. A 67 times price to sales ratio mathematically requires a nearly 100% conversion rate of their pilot programs just to justify today's current price. Any slight bump in the road and the multiple compression will be absolutely brutal. Which leads us to a brutal reality that every single growth investor absolutely has to accept. At 54 times guided sales, there is absolutely zero margin for error. When a stock trades at these extreme levels, absolute perfection is no longer a goal to strive for. It is the bare minimum baseline expectation. If Palantir falters even slightly in converting those bootcamp pilots next quarter, or if we see a sudden hawkish shift in macroeconomic conditions, this stock will reprice violently. And I am not talking about a gentle, healthy little pullback here. I am talking about a severe, rapid valuation contraction. The underlying software is undoubtedly superior, but superior technology does not automatically protect a stock from multiple compression when the valuation is stretched to its absolute breaking point. And as it turns out, the one person who might understand this best is the very man running the company. On August 20th, SEC filings revealed that CEO Alex Karp proposed the sale of 402,348 shares of restricted stock, followed by an additional notice to sell 90,000 shares. The total value of this proposed liquidation is approximately $70.34 million. Now, to be fair, these sales are very likely executed under pre-planned Rule 10b-5-1 trading schedules, and insiders sell their stock for all kinds of perfectly innocent reasons. But seeing the CEO unload over $70 million worth of stock in a single week, right as the shares are touching historic all-time highs, really makes you stop and think. Does management quietly view this $170 to $180 range as a near-term valuation ceiling? But Karp is not the only major player acting on these sky-high prices. A very famous bear is now actively betting on a full-blown collapse. Legendary investor Michael Burry has officially doubled down on his bearish Palantir trade, purchasing March 2027 put options and betting that the stock is headed significantly lower. Burry is executing a structural critique of this 54 times guided sales multiple. And his bear thesis has a powerful macro ally standing right behind it: interest rates. Growth stocks like Palantir are hypersensitive to interest rates because their massive projected cash flows are pushed way out into the distant future. As the market watches the Federal Reserve's Jackson Hole Symposium, any hawkish messaging that spikes bond yields will automatically discount those far-off future cash flows. And that would drag Palantir's multiple right back down into the low 100s, regardless of how great their technology actually is. So with the fundamentals and the macro forces locked in a dead heat, where does this stock actually stand on the chart today? This brings us straight to the tape. Palantir closed Friday's session at $179.94, climbing over 3% and touching an intraday high of $182.44. We are literally sitting right on the doorstep of a massive technical threshold. But before you rush in to buy the breakout, take a hard look at the gauge on your screen. The daily relative strength index is sitting at 74.7. What that tells us is that the stock is now deeply overbought on a technical basis. This straight line push higher is getting historically tired, having consolidated down in the low 170s before Friday's aggressive buy programs violently pushed it right back up to the highs. To navigate this critical zone properly, we have to map out the exact price levels where the buyers and sellers are waiting in ambush. When we chart the key support and resistance channels, the lines in the sand become crystal clear. Our immediate overhead ceiling sits at $183.15. That is the major resistance wall the bulls absolutely must clear decisively to sustain this entire run. Below us, our first line of defense is the immediate floor at $171.04, which represents the natural technical cooldown level if this momentum starts to stall out. And below that, we have our major weekly breakout level and structural support waiting at $159.58. These are the exact channels that will dictate the price action over the coming weeks. So let's look at how this all plays out under two distinct and highly realistic scenarios. In scenario A, the bulls take complete and total control. If we get a decisive high-volume daily close above that $183.15 resistance wall early in the week, it will trigger a powerful technical breakout. Momentum traders and institutional buy programs will immediately chase the move, fuel a continuation of the short squeeze, and propel the stock straight toward our initial target of $196.32. And beyond that, the door swings wide open for a run toward the major psychological barrier of $200. Now, I know that sounds incredible, but in a momentum-driven market like this one, technical breakouts can run far, far further than the fundamentals would ever suggest. But as smart, disciplined investors, we must always prepare for the alternative scenario. In scenario B, the bears defend the gates and hold the line. If the stock fails to secure sufficient buy volume up at the highs, we will see a sharp technical rejection right at that $183.15 wall. Combine that rejection with the overbought 74.7 RSI reading, and you have the perfect recipe for a healthy, natural technical reset. Profit taking will then drag the price down to our immediate fade target of $171.04. And if that immediate support level fails to hold firm, we should fully expect a deeper slide to test the major weekly breakout support all the way down at $159.58. This brings us to the ultimate question you have all been waiting for. How do you actually play this stock with your own hard-earned money? Here is our definitive, actionable playbook. For short-term swing traders, the verdict is to maintain a strict hold and wait patiently for pullbacks. With the RSI screaming over 74, chasing this breakout up at $179 carries a highly unfavorable risk-to-reward profile. The smarter move is to wait for a pullback into the support range between $171 and $159 before entering. But for long-term investors, this stock remains a high-conviction, strong buy. Focus your attention on the sheer compounding power of Palantir's 157% net dollar retention and systematically accumulate shares on any macro-driven pullbacks over the next 24 to 36 months. Now, before we wrap this all up, I need to be crystal clear with you. Everything discussed in this video is for educational and informational purposes only, and it is absolutely not financial advice. I am not your financial advisor, and I am not a licensed professional. Every investment carries real risk, including the potential loss of your capital, so please always do your own thorough research and consult with a qualified financial advisor before making any investment decisions of your own. So there you have it. Palantir is a company with a bulletproof engine strapped to a valuation stretched to its absolute limit, leaving zero room for a single mistake. Now, I genuinely want to hear from you down in the comments. If you had cash ready to deploy today, would you buy the breakout above $183, or would you patiently wait for the pullback toward $159? Drop your answer below because I read every single one. If this deep dive teardown brought you real value, please hit that like button and make sure you subscribe and ring the notification bell so you never miss our next breakdown. This has been Calvin Mateo. Trade smart, stay disciplined, and I will see you in the next one.